Good afternoon, class. Hopefully you guys are getting through the week okay. I imagine there are a lot of exams, so keep up the good work and hang in there. Today we are going to start covering Chapter 6, which is about bonds. Okay, so bonds. Well, bonds are nothing more than loans that have been kind of packaged up so that they look very similar to other bonds, except the bonds vary by the maturity, how long they last, and which company or government issues them. But they have a lot of standardized components to them, and because of this, they can be sold and bought on financial markets all over the world. Now, in the U.S., a standard bond is like $1,000 loan, and so what I mean by that is bonds are basically loans, right? And the standard unit for every bond is $1,000. And so these are traded all over the world. In fact, the market for bonds is several times bigger than the market for stocks. Common stocks, like the things that we're buying on StockTrack, but bonds, because they include all the governments that issue bonds, not just companies that issue bonds. So it's a huge market, and sometimes since there are so many different types of bonds, they don't always trade very easily on stock exchanges like you're able to buy and sell on StockTrack. So bonds are not as automated in terms of buying and selling as stocks are. And in fact, today, bond traders, they still go back and forth with their bond trader and the investment banks who will have desks that handle buying and selling bonds, and they'll message each other. Buyers and sellers will message each other. It's not as automated, where you'll never talk to someone or message someone like with stocks. Bonds, there's so many different types of bonds that they don't have standard listings, and there's a lot that still gets sold just by contacting people. And a big reason for that too is that once people buy bonds, a lot of the investors hold on to them for a long time. So with that, let's go ahead and look at some of the particulars about bonds. So here's some of the bond terminology. A bond, so specifically, it's a loan, and the issuer, the person who sells the bond, could be a company, or it could be a government, or it could be kind of a quasi-government company organization, kind of like we have here in the U.S. Fannie Mae, Freddie Mac. They're kind of supported by the government, but they try to improve the mortgage market so it works better for people. And so these securities, their base value is $1,000. I mean, that's the amount of the loan. And the issuer, the company or the government, is required to make future payments of interest and ultimately repay the value of the loan. Now, the value of the loan is $1,000, and that doesn't get paid back until the very end of the loan. And normally, when we make the interest payments on a bond, that's what happens every period. So interest is paid every period, and not until the very end does the loan value get paid back. So the loan value, we call that the face value. You may see other terminology used for it: par value, principal, like a loan principal, or maturity value, how much is due at maturity for a bond. So those kind of all mean the same thing. And in the US, the standard is $1,000, and it's always paid at the end. Now, the interest payments that get paid every period for bonds, they have a specific name, and those are called coupons. And they're paid from the bond issuer to the bond holder, who is the person who bought the bonds. And in the US, Coupons are paid twice per year, so that's semi-annual. So that's going to be very important for us when we go to do the time value of money math, because you remember that compounding period is based on when the cash flows happen. So with bonds, the compounding period is every 6 months. Just an interesting side note, bonds have been around a long time, and I saw some copies of bonds, and they're obviously on paper, and they're over like 150 years old. It was from when they were building railroads across the United States, and the railroad companies, the different private companies, were trying to raise money to buy the equipment and pay the workers to build the railroads, right? And so what they did was they sold bonds. That's how they raised the money. And when you bought one of these bonds, you got like a big piece of paper, it's almost like a diploma or something. It said, XYZ Railroad Company. And at the very bottom, there would be like these little things you tear off. And those little things you tear off are like coupons. So I don't know if you ever get the Sunday paper, but if you see in a Sunday newspaper, you know how they have like a lot of circulars and ads, and sometimes you'll see coupons that you kind of tear off, right? So that's where this term coupon comes from. It's because originally when these bonds were issued on a piece of paper, you would tear off this coupon, and you would actually go to the bank or the post office where you could kind of check it in and get the value of that coupon from the issuer. And then we have the coupon rate. So the coupon rate is basically the loan interest payment. So it's used for calculating how much that coupon payment is every period. And that's the only way it's used, okay? And so what I mean by that is the coupon rate is not used as our discount rate when we do time value of money. It's only used to calculate the cash flow or the coupon payment. So, and also the coupon rate is an annual percentage rate. That's how it's given. So, give you an example here. If the coupon rate is 10% and the face value of the bond is $1,000, this coupon rate will tell you the annual interest, kind of like an APR. And so 10% coupon rate times $1,000 face value, that means the total coupon you pay every year is $100. Okay, that's how the coupon rate is used, and that's the only way it's really used. This is how bonds are priced. And we're just using present value here. And it's basically like when we talked about present value of multiple cash flows. We have cash flows that happen at different periods of time in the future. And so that's exactly how a bond is handled when we price it. And so it's got two components here. One is every coupon. And so every coupon is the same payment every period, which sounds kind of like an annuity, right? But then the difference here is that we also have one big lump sum payment at the end, which is par or face value of the bond. That's where the principal of the loan gets paid in full at the very end. Now, in this equation here, the R, that's the discount rate, right? That's a discount rate. But for us, that's going to be the yield of the bond, okay? And another term for that is the yield to maturity. So if you look up a bond on the internet, and if it's a bigger bond offering, you can get information about the bond, and you'll see the price quoted and the yield to maturity, okay? And the yield to maturity is basically calculated as is the R that gets us the PV in this equation up above. And PV is kind of like the price. So when we take the future value of all these future cash flows, using the yield to maturity as our required rate of return or discount rate, that's what investors require for their return, then the PV is basically going to be the price. So I see a question here from Yannick. So this formula is for bond price. Yes. So this is how we calculate the price today of a bond, and it's basically the present value, same thing. What is the difference between the bond yield and the coupon rate? So the coupon rate is only used to calculate the coupon payment. Okay? And so it's stipulated in the bond contract, and unless it's a variable rate bond, the coupon rate never changes. Okay? But that's the numerator or the coupon in this formula. But the R in this equation, that changes over time, and that's all based on different investors' opportunity. What the opportunity cost of capital or what returns investors can get for other bonds. So the coupon rate is set when the bond is first sold. But then over time, you know, as interest rates change, and we'll see this more in the rest of the presentation today, that R will go up and down. Like, let me give you an example. The 30-year interest rate a year ago for like let's say it was I don't know, 4%, something like that. But nowadays it's only like it's like 2.5 to 3%. And so if I'm investing in bonds, last year I was okay to invest around 4%. I'd buy that bond. But this year I can't get that because the best deal I can find is like 2.5 or 3%. And that's that opportunity cost of capital, because investors are looking for the best deal they can find. And when the investors look at all the coupons in the bond, they have to decide on that discount rate themselves to figure out what the value of the bond is. But when we go to and when you go to look up the yield to maturity on a bond, what they're going to do is something we're going to do next week, is they actually look at the PV or the price from the market and the coupons, and they actually calculate the yield to maturity based on the price and the coupons. But we're not going to do that today. But today we're going to be given the yield to maturity, and we're going to calculate what the bond must be worth or the price today. So the bond yield is the discount rate that we use, and the coupon is used to calculate the cash flow. That's the major difference. We have another type of yield on bonds, and it's called the current yield. And I think this is specifically one question on your homework. So you may want to star this equation. So the current yield is basically the annual coupon payments. That's in dollars. The total annual coupon payments in dollars divided by the current bond price. So it kind of gives you what you get in terms of a return just for the next year, only from coupon payments. It's kind of like if you were just investing in a bond for the short term and you wanted to get a feel for what your return or yield would be over the next year, so you could compare it to like a savings account or a CD or something. You might look at the current yield and get an idea of what kind of return you can get on that bond. Just to talk about the bond yield, that's the yield to maturity. And so what that means is that that's the average rate of return you get every year on that bond if you hold it to the end. Yield to maturity. That's your return until the end. That's what yield to maturity is, okay? Assuming you buy it at the current price. But for us, for today, I'm going to give you that yield to maturity. That's the discount rate. And then you're going to calculate what the price of the bond must be. Let's do an example. So what's the price of a 5% annual coupon bond with a $1,000 face value and which matures in 3 years? And assume that bond yield to maturity or the required rate of return is 2.15%. So a couple things here. So this is just a simpler bond example because you're given an annual coupon. So we don't have to worry about the semi-annual. We'll do that in a couple more slides. So that means the coupon payment is annual every year, and I think the interest rate, because we're not told that it's a 6-month rate or a 3-month rate, the interest rate is also over a year, so we don't have to make any adjustments like we did with those APR, time value of money problems. The coupon's annual and the required return is annual, so we don't have to make any adjustments. Now, when we calculate the coupon, this is how we do it. We take the coupon rate and we multiply it by the face value of the bond. That's right here, okay? Now, if the bond is an annual coupon like we see here, then we just divide it by 1, number of payments per year. But if the bond is semi-annual, 2 coupon payments per year, then we would divide it by 2. Again, this is a simplified example, so we don't have to worry about that. But the coupon payment will basically be 5% of $1,000, or 0.05 times 1,000, which is going to be $50. So this bond will pay a $50 coupon once per year. That's what that says. Here's a kind of a timeline of the cash flows. So let's assume in the beginning, we pay for the loan, we pay for the bond, excuse me, and it's a negative cash flow, right? Because we have to pay money out. And then in the future, in 1 year, we get a $50 coupon. The next year, we get another $50 coupon. That's positive cash flow coming to us. But in the final year, we get the final coupon of $50 plus $1,000, which is the repayment of the loan principal, if you will. Because remember, the $1,000 is the standard face value or loan principal for a bond, a traded bond. So this is the same example. Let's go ahead and do the calculations now. So 2 things here. This first equation, this PV here, that shows how to calculate the price or the value of the bond in present value terms using the $50 coupon payment and the 2.15% discount rate, okay? And then notice it's 3 periods, and also at the very end we get $1,000 plus the $50 from the final coupon payment. So that's a pretty basic setup for a bond in terms of calculating the present value. You get 1081.95. And then if we were to use the Excel formula, we could do that using the PV function. And you see down here, it's PV, and then we input the rate, followed by the number of periods, which is 3 years, followed by the payment per period, which is $50 coupon, followed by a lump sum at the very end, which is the $1,000 face value. So that would give us the exact same answer if we did it in Microsoft Excel using the PV function. Any question on that example?
So we don't have to put like the total payment over the 3 years because it says the 3 years is kind of incorporated already into the Excel formula? Like sorry, I was gonna say because the $50, that's the yearly payment, and so I wasn't sure if you're supposed to put like the total, or if you're I guess the year, because then you have the 3 years. I guess I answered my own question.
Yeah, as soon as you put it in the spot for Excel that's called PMT, payment, that means by definition it happens at the end of every period, right? So if for example, if we put in 1050 in this problem, we'd be double counting that 50 then at the end.
Oh, okay.
So it takes care of the $50 periodic payment by putting it in that third number in the formula.
Got it.
Okay, let's take a look at what happens when we do a semi-annual coupon. So let's see what in the calculation changes. So a couple things are going to change. The time period is going to change. So if we're doing it annually, right, the time period is once per year. But if we're doing coupons semi-annually, then the time period is two periods per year, 2 6-month periods per year. So for example, if we have a 10-year bond, if it's annual, there are 10 periods, but if it's semi-annual, there are going to be 20 periods. So the time periods double the number of years when we go to a semi-annual bond. Also, the discount rate's going to change. And here, the number of periods, I'm sorry, the time periods are now 6-month time periods. So the interest rate that we use for our calculations has to be a 6-month interest rate and not the annual rate. So it's pretty simple here because the rates that were quoted on bonds are APRs, annual percentage rate. So to convert from an annual rate to a 6-month rate, all you have to do is divide by 2. So it's pretty simple. And then you know the coupon payments are going to change too. So the coupons are going to be split over the year. We'll still have the same annual coupon payment total, but it'll be 2 separate payments. So let's do that same problem that we just did with the 5% coupon. But now let's change it so that the coupons are paid semi-annually. Okay. So the first thing, let's calculate the coupon payment. Now it's the coupon rate 5% times the face value of 1,000, but then we divide it by 2, so that gives us half the payment that we had before, but it's going to come every 6 months instead of once a year. So our coupon payment now turns to 25. And then in terms of the discount rate, we take that annual rate and we divide it by 2, and that'll give us 0.01075. It looks like I forgot to divide by 2 in the formula there. Sorry about that. But there should be a 2 right here. So 0.0215 divided by 2 equals 0.01075. And then the number of time periods is going to double, right? Because now we're going to do it twice a year. And so that goes from a 3-year bond to now 6 payments in a 3-year bond. So 6 periods. That is what the math is going to look like. So we've got $25 coupon payments, and we discount it back 1 period at the 6-month interest rate that we calculated, 0.01075. That's 1 plus R in the denominator there, right? And we do that for every single payment up until the very end when we discount back the combined face value of 1,000 plus the very final coupon payment of $25. So that'll give us 1082. And I'm pretty sure, I think that should be a little bit higher than just the previous example we did, right? Let me just double check. Yeah, the last one was 1081.95, and this, everything was the same except we went semi-annual and the price went up a little. And that's because we're getting our interest sooner, right? Like the very first coupon, instead of us getting it in 12 months, we're going to get it in 6 months. So when you get your money sooner, it's always going to be worth more to you, right? If we do this in Excel, this would be the formula down at the bottom. We put in the rate first, 01075, followed by the number of periods, followed by any periodic payments, followed by a one-time payment at the very end. All right, let's look at another example. This example is going to show us the effect of changes in that R, the discount rate in the formula. What is the price of a 5% annual coupon bond, 3 years to maturity, if the required rate of return is 5%? And that would be the answer. Fairly simple setup. It's just annual coupon. And now let's go ahead and change that to 8%. So if we change it to 8%, that means the denominator down here, instead of being the 5% we just saw, now it's 8%. And look what happened to the price. So what just happened to us, the discount rate that we were using, 5%, we increased that to 8%. But when we calculated the present value, it went down from 1,000 down to 922. And so this is kind of a fundamental concept with bonds, that the price is inversely related to the discount rate or yield to maturity. And so this is one of the biggest factors in bond investing that people have to understand. When interest rates go up, bond prices go down. Okay, and it's kind of a strange thing, but this is what it looks like if we were to look at it on a chart. This chart right here, this line, kind of shows you the relationship between the price of a bond and the discount rate or the yield to maturity. And sometimes people just say interest rates in general. And the reason they say interest rates in general is because when a major interest rate, like like the government is trying to bring down interest rate, and let's say they're trying to bring down long-term interest rates. If they're successful in doing that, interest rates come down. What that means is it affects every single bond out there. So it's not just the yield to maturity on your bond, it's every single interest rate is going down, and it affects all bonds. Because all the interest rates out there are the world of opportunity that investors can invest in. So if the world's interest rates go down over here, it's going to affect any bond that you're looking at investing, because investors will gravitate toward the best deal, but eventually all the different bonds will have to kind of come to an equilibrium, and all the prices will adjust, so everything kind of looks pretty similar. And here we can see this was the bond price we originally calculated, this bubble to the upper left. It was $1,000 and it was at a 5% interest rate or yield to maturity, right? Then we increased the interest rate or the yield to maturity to 8%, and the bond price went down to around 900. So, so that is called interest rate risk. And it's one of the key risks in investing in bonds. So what this means is that if you're a bond investor, yes, you have your coupons coming in every 6 months. But if interest rates change, depending on how they go, they could hurt you or help you, because the price of the bond that you owe is going to change as well. You still get the coupon payments coming to you every 6 months. But if you then go to sell that bond to another investor, you might get some value different than $1,000. That $1,000 face value, which is what bonds usually sell for when they're very first sold, will change over time depending on what happens to interest rates. Let me give you an example. So interest rates have come down quite a bit over the last year, especially long-term interest rates. Let's say that you bought a bond that paid a 5% coupon last year. Okay, and that's because the issuer, who was a company, when they sold the bond, they had to offer you 5% because that's what all the other bond investments were paying at the time, right? They couldn't have sold a bond with only a 3% coupon at $1,000 because people wouldn't buy it because they didn't want to get a 3% return when they could go buy a different bond and get a 5% return every year. Now fast forward to today. Interest rates have dropped. If that bond you bought last year, paying 5% coupon, right? Now let's say the same company wanted to issue more bonds. Now interest rates are a lot lower. Guess what? They don't have to offer 5% anymore when they go to sell a new bond today. They can get away with offering 3% because investors see the world out there that's paying low interest rates, and investors are willing to buy a bond with a 3% coupon. Okay, so the bond sold last year paid 5% coupon, and the bond sold this year is only paying 3% because interest rates have gone down. Now here's the thing. You still own your bond you bought from last year. What do you think's happened to the price of that bond since your bond pays 5% and the coupon and the bonds today that are being newly issued only pay 3%? I'd much rather have your 5% bond than buy a new bond today. What that means is that the price of your old bond that you bought last year is going to go up. It's going to go up because you bought it when interest rates were high and it had a higher coupon, which makes it look really attractive today compared to the current 3% coupon. So that's kind of a thing that people don't always understand. It's not necessarily intuitive with bonds, but it's the major thing with bond investing. You have to understand this relationship between the overall interest rates in the market and how they affect each individual bond pricing. So that's that inverse relationship. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up, like in the example from buying the 5% last year. And this is kind of what we just talked about. Here's a history about, it looks like about 150 years of history in 10-year treasury bonds, right? So the US government, when they need to raise money to operate the government, they sell bonds. And what this data does is it tracks the yield to maturity on those bonds over time. And you can see, boy, that's pretty crazy what's happened over the last 150 years. It looks like they were fairly low and they just kind of crept up in about 1920 toward looks like maybe the tail end of World War I. And then they just kept going down. And then in the 30s, during the Depression, worldwide depression, they kind of started sinking. And then into World War II, in the 40s, they kind of hit a low. And then they've been creeping up ever since then, all the way until about the early 80s. And this was a difficult time period in the 80s, early 80s, 70s, because we had a lot of inflation. So depending on your point of view, you might think these high interest rates were really good, but typically good things don't happen with super high interest rates, because usually it means that inflation is very high, and that's why interest rates are so high, to compensate investors for all the inflation that we have. And so high inflation is usually never followed with a good economic story for a country. Just Google high inflation somewhere in some country at some time period, and you'll see that it was misery for the people in those countries. When you're worried about the price of some food doubling in a couple weeks, people start doing strange things. They probably do, like, it's probably like some of the stuff we had with COVID-19. The shelves start disappearing. People are worried about prices going up. Companies can't keep increasing their wages. So it's a bad situation. But since then, look at that, how interest rates have basically fallen since around 1980. And so what that means is that in general, bonds have had a great run of it since about 1980. But if you look at this right now, 10-year bond rate, I think, is around 1%. 30-year bond rate is around 1.6 or something. It's hard to imagine them going much lower, but that's what people have been saying for the last 10 years, that they couldn't go much lower. And so anyway, so what that means then, right, is the interest rates, the yields went down. That means this whole time prices kept going up. So that's what I mean when it's been a pretty good run, because in general, when interest rates are going up, people who hold bonds are not happy. But that's really not been the case over the long term for the last 30 years. Another interesting thing to note here is you'll see whenever there's a dip in the interest rate, like around here, early 90s here, this looks like maybe the year 2000, 2008 here, and then I think 2013 again. Those are like little recessions almost. And what's happening there is the government is working to reduce interest rates. And the little ups and downs in that interest rate are kind of following the economy in general, because the government will work to reduce interest rates when economic times are hard. So it's easier to borrow money, so people buy more stuff. Because when people buy more stuff, then people have to be hired to build more stuff. And so the thought is that the economy will improve if people start spending more money. And that's basically why the government keeps trying to drop interest rates, is to get the economy to grow. But if you look at this, it's like they've used up most of the interest rate they can to help prop up the economy. And it's going to be a hard thing, you think, going into the future. We'll see. What I want to do right now is, why don't we do a couple examples of bond pricing in real time, and that way I can make sure that you guys are kind of getting this. So I am going to stop the presentation from here. We'll finish it up next week, and I'm going to share with you an Excel spreadsheet. So we're gonna cover some problems, and I'll give you some time to work on them. And if you're watching like on a phone or something like that, or a pad or something where it's hard to do work yourself, just think about some of the key pieces of information you'll need to solve the problem. Okay. So let's do an example here. So here's the question. What is the present value of a bond with a 10% coupon paid semi-annually with a 3% yield to maturity, We'll say that's the same as the discount rate. And let's say 9 years to maturity. All right, so let's. I'm just going to list what information we need, right? So PV, that's what we're going to solve for. So we don't know that, but we need to know the periodic rate, right? We need to know the number of periods. We need to know the periodic payment. And we need to know the future value payment, that lump sum at the very end. So those are all the things that we need when we're doing our problems for time value of money. So go ahead and work on that for, I'll give you about like 5 minutes or so. And if you're not able to do work on it, just think about what the periodic rate is. Think about the number of periods, how you would calculate that. Think about what the periodic payment would be. And think about what the future value would be. So see if you can get those numbers in your head. It might be hard to calculate the price, but give those inputs a shot. So if you're using a calculator, that's fine. Go ahead and practice on the calculator. If you're using Excel in the computer, that's fine. We'll take as long as it needs to take. I just want to make sure that we're kind of all on the same playing field here, in other words, so that I just want to make sure everyone's with me.
So the face value is always 1,000?
Yeah, you can assume it's always 1,000. And when you get an answer, just go ahead and post it in the chat. If you have a question, just open up the mic and ask me, or put it on the chat as well. And if you don't have Excel on your PC, just think about what the different numbers are that would go into calculating this. You can also use a calculator. You can do it by hand. If you're going to do it by hand on a calculator, yeah, it could take a while. All right, let's take a look at some of the data we need to solve the problem first. So how do we calculate the periodic rate, the discount rate every 6 months? What do we have to do to get that number? And just unmute yourself on the mic, or just post something on the chat, and I'll be watching.
It's the 10% coupon rate times the face value, which is 1,000, and then you have to divide by 2 to get the periodic rate. Or is it the yield to maturity rate?
It would be the yield to maturity, yeah. Yeah, okay. The key on these problems is the coupon rate is only used to calculate the coupon payment. That's it.
Okay. I was looking at the wrong Okay, I was looking at the wrong one.
Oh, it's all right. It's all good.
Yeah, it's the yield to maturity divided by 2.
So it would be 0.03 divided by 2, right?
Yeah.
That should be our discount rate. So 0.015. And then the total number of periods, how about that? How many 6-month periods are in this bond?
18.
How'd you get 18?
9 times 2.
So 9 times, so 9 years times 2 periods per year, right? Yeah, so that's 18. And I think we kind of answered that coupon payment, right? You take that 10% coupon rate, you multiply it by the face value, and then you divide by 2 to make it every 6 months, right? So that should give us our coupon payment right there. And then face value at the end, what are we going to put for that?
1,050.
Just 1,000.
It'll be just 1,000 because the 50 we already know. We already calculated that for every single period. So this is just the return of face value at the end, okay? I know we have a coupon payment at the end as well, but we're going to keep that separate for now. So if we calculate this the math way, and this is why it was going to take a long time on the calculator, right? It's going to be the first coupon divided by 1 plus the interest rate, 0.015, all to the power of 1, right? Where's my up caret? And then we've got the second one to do. And we're going to be here a long time, guys. And so we're going to have to do 18 of these. Golly. I'm going to skip to the last two. They're going to look something like this just to help save some time. And maybe, I think in the next example I'll just do like a 2-year bond. Let me make my screen a little bigger here. So if you were to do the math way, the long problem, you would do something like this for every single term, right? And actually, I think I need a little ... in here. So there we go. I think that would be your solution.
Shouldn't the last two exponent be like 17 and 18?
You are right. I apologize. I was just seeing if you were paying attention. How's that look?
Perfect.
Perfect. I got a question here. FV can signify future value or face value. So for time value of money purposes, FV is always future value. It just so happens that when it comes to bonds, face value is also put in the future value formula at the same spot. So they both have FV abbreviations, so they look kind of similar, but no, it's really just future value, okay? But in this case, the future value is the face value of a bond. Someone asked me if there is an easier way to answer this one in math, and there kind of is. What you do is you calculate the present value of a $50 annuity, and then you add to that present value of face value of the bond. So you could calculate it like this if you want, and that might save a few. Whoops. Present value of So here's another way to do it. You could have done it like this with math. That might have saved you a little bit of time. I think it probably would have. So, but you do this and you can check it on your own time. You should get the exact same answer, okay? And this will be $1,000 face value, okay? And someone said Excel is easy, so let's go ahead and tell me what to put in the Excel formula. What's the first thing to put in here?
$0.015.
That's our discount rate, right? So first thing is the rate. And what's next?
50, believe.
18.
The number of periods, right? 18.
50.
50. You got it. And what's the last thing?
1,000.
1,000. And so that should give us 1548. And again, here was that formula. There's the formula I used for that. Any questions on that problem? I'm gonna do one more problem just to make sure we're on the same page. So go ahead and solve that one, please. All right, let's take a look at it. So, all right, let's do the rate first. What did you use for the 6-month discount rate? Something like that, right? Because the discount rates we're usually given are on annual terms. So given semi-annual coupons, we always have to convert them on a 6-month basis. And how many 6-month periods in 2 years? That's an easy one, right? Four, right? And what's our coupon payment? I think, yeah, right, 45. So it's 0.09, right, times by 1,000. But then we have to divide it by 2 because it's split over the year into 2 payments. So that means each payment is going to be $45. And then the face value at the end, that's just 1,000, right? So let's do our formula here. And we should get 1,000. Oh, isn't that funny? 1,000. So here's a little trick. Whenever the coupon rate is the same as the discount rate or yield to maturity, your answer is always going to be 1,000. And it just so happens, right, when bonds are sold for the very first time, they look around the world of interest rates and they say, okay, here's our bond. We want to put the same coupon rate as other similar bonds that are on the market right now, assuming we want to sell that bond for $1,000. So they kind of set the price. They know they want to sell the bond for $1,000, and then they adjust the coupon rate so that investors will be like, oh yeah, I'll pay $1,000 for that. And so when you see that coupon rate equal to the discount rate, that's kind of the ideal bond offering where they set those rates equal and it's going to sell for $1,000. How about the math? So hopefully the math is a little easier on this one, right? So you got something like 45 divided by 1.045, right? And you know what? Yeah, 45 divided by 1.045 plus 45 divided by 1.045 squared plus 45 divided by 1.045 cubed. And then the last term is 45 divided by 1.045 to the fourth. Or did I mess something up there? There we go. Right, so that'll be the math. You know, if I'm in a really bad mood when we're putting together this quiz in 2 weeks, I might put a 30-year bond on there. But I wouldn't do that to you. I'm just kidding. So that what's that?
Please don't.
I'm just kidding. I wouldn't do that to you. But it's going to be more than a year, right? I can't do 1 year. So, all right. So that's it, class. All right. See you, everybody.